portfolio. Today, I'm honored to welcome Robert J. Shiller, Sterling Professor of Economics at Yale University and the winner of the 2013 Nobel Prize in Economics. Bob, thank you very much for joining us today.
My pleasure.
So Bob, I want to start by talking a bit about your background. How did you choose economics? What was the decision-making process when you made a choice to come to MIT for graduate school?
Well, when I was young, I thought everything sounded interesting, and I thought it was a great tragedy that I had to narrow down to one thing. Economics? You know, it was Samuelson here at MIT who got me into economics when I was about 14 years old. My brother came home from college with Samuelson Economics, and I read it. So maybe economics sounded like a field that brings things together. You can do mathematics, there are physics analogies, and then there are people and history. So I guess I had to make a decision. I picked economics.
Right. Yeah, well, that's terrific. And you came to MIT, of course, and your thesis was actually on rational expectations models. It was actually pretty technical, wasn't it?
Yeah, also distributed lags. Yeah, econometrics appealed to me, and modeling appealed to me.
And it was one of the first research articles that really focused on the econometrics of rational expectations. Isn't that right?
I was interested in robustness. You know, I didn't really believe, no one really believes these models, right? They're always wrong. But I wanted to get at the insights from it, and I thought, I was thinking about that, and thinking about how to quantify things got me into fundamentals of probability theory and Bayesian econometrics.
Yeah. So you have to understand the irony then when we now turn to your research on behavioral economics and finance, because a lot of the early work that you did was actually quite important for developing the foundations of rational expectations, econometrics. So at some point you decided to focus on alternatives to the rational expectations paradigm. How did that come about? I mean, it was a long process, short process?
Well, I've always been interested in people. When I go to sports events, which is rarely, I find myself watching the crowd rather than the game. I don't care who wins this. I don't know, maybe it's me. There's something missing in my motivational structure. But I'm just fascinated by people.
And so in thinking about people, obviously macroeconomics is another field that you've made a number of contributions in. That's obviously a very important area because you're looking at the aggregate behavior of lots of people interacting. How did you get interested in that, from rational expectations to focusing on macroeconomics?
Well, it's hard to describe how one got interested in anything. I was influenced particularly by Franco Modigliani, my professor here, who, I don't know, he was just a connected person who did quantitative work and also cared about what was happening in the world and knew about those things. So, but it wasn't any one specific person. I think it's also partly random. I could have gone into medicine. I could have gone into physics. Academia is a nice environment. Unfortunately, a little bit competitive and sometimes stressful, but I could be in, right? You agree, right? Any of these departments, there's interesting work to do.
Yeah, well, we're happy you went into economics and finance. And along those lines, one of the things that you pioneered was real estate indexes. I mean, the Case-Shiller indexes are now used all over the world to try to understand real estate markets. When you started working in that area, that wasn't a particularly popular area for economists to be working in, is that right?
So here's one of my observations about people. They run in herds, and people do the same. And in the short run, that might even be the optimal strategy. If you're a young person trying to get ahead, you have to go to conferences, for example, and that means you have to get immersed in what other people are doing.
Yeah.
But I also think that people miss things. You know, the big opportunities are not in advancing the current dialogue, but it's more in looking at something that nobody else is doing. And in this case, I think real estate was under-researched in business schools. And when I worked with Carl Case here, there wasn't any serious index of home prices. there were some, and they didn't go very far back. It's like nobody cared. How can nobody care about? We all buy houses, and we at that moment it focuses your mind, and you think, what's the market going to do?
Yeah.
But I thought I would just do it. And by the way, I didn't push to get it into a top journal. I thought these specialty journals are some of the most interesting places. They're not the most prestigious, but real estate economics was a specialty that I don't think it had the highest status in the profession, and it wasn't attracting enough interest.
Well, you certainly elevated that with your indexes and then a number of papers that you published afterwards. In fact, so you've now managed to call two bubbles pretty early on. One was, of course, the tech bubble that you had talked about, the fact that the market was overvalued. But then after the bubble burst, you continued and talked about the real estate bubble. So the whole irrational exuberance period, the phrase that you coined, can you tell us about that? In particular, your fateful lunch with Alan Greenspan.
Okay.
Because he took that idea, he mentioned.
Yeah, I'm not sure who coined it. Actually, it goes back 100 years. But Alan Greenspan made it famous, and maybe I helped a little also.
Right. So tell us about that fateful lunch.
Well, I was invited with John Campbell, my co-author, to testify before the Federal Reserve Board in 1996. And this focuses your mind. Here we're getting a hearing from a very powerful body. And John Campbell and I decided to describe what was going on as a bubble. A little early, because the market didn't peak until 4 years later, or 3.5 years later. And we had lunch with Fed board members, including Alan Greenspan. We told them, hey, this isn't rational, this is psychology. And 2 days later, Greenspan came out with a speech in which he used the word irrational exuberance.
Now, how did you come to that conclusion? Because that's a pretty stark contrast to what many other people were saying at the same time.
Well, it's kind of like, I just mentioned that I used to go to sporting events and watch the crowd instead of the game. The crowd is so much more interesting. Why do they care? Or why do they get all, you can see their body language when someone's making a difficult move and they almost feel that they're doing it. It's empathy.
Yeah, so what were you seeing in 1996 in the crowd?
Well, I thought that it was so obvious to me. I played a game with my wife when we went out to eat. I said, now I'm not going to listen to other people's conversation, but I have a ability to hear the word stock market, okay? And every time, from adjacent tables, every time we went out to eat, I would hear stock market. It's uncanny how the spirit of the times changes.
Right.
And suddenly everyone's excited about something. So I based it on that, that kind of observation.
But you also measured things like PE ratios and other kinds of analytics. What were the analytics telling you at the time?
Well, I had a ratio, John Campbell and I had a ratio that we now call a CAPE, or cyclically adjusted price earnings. It's just a price earnings ratio where the denominator is smooth, the earnings is smoothed over 5 or 10, well, usually 10 years. That's because earnings are very volatile from year to year. It's the basic idea of just a price earnings ratio. And we saw that getting into record high levels. So we looked historically at what does that portend. Well, there aren't many examples. That's the problem with history. There aren't enough examples of these extraordinary circumstances. But what happened when the ratio gets high, price over earnings, what changes to bring it back? Is it the earnings go up or the prices go down? We found that historically it was the prices go down. So it was a model of human psychology that just sometimes everything looks great, and we're all excited. And it's best to stay away from crowds that are overly excited about anything.
Well, so just to replay history, 1996 was really the beginning of the internet bubble developing. I mean, it hadn't peaked anywhere close to where it ended up in 2000 when it started coming down. So you were quite early. What were the reactions of your colleagues and people in industry at the time? Was there a fair bit of acceptance, skepticism?
Well, there was an enormous skepticism. Like, you are embarrassing our academic community. We have solid econometric evidence that markets are efficient. What are you talking about? That's the reaction. It was,
Right.
it was angry. And it was that there's a conventional or received wisdom in the profession. But actually, if you look at the data, it's one of these things. People have the impression that there's all this evidence supporting market efficiency. But you look at the literature, even the literature in 1996, there were lots of anomalies being reported.
Right, that's right. So in retrospect then, after the internet bubble burst, did you find more acceptance of your ideas, or is there still resistance? Because you have a second bubble that we're going to get to in a minute. It's real estate.
Yes,
That's
right.
the big one.
I think that the econ profession has always had a tension between the rational quantitative types and they're still quantitative maybe, but the psychological type. It's kind of, people have tastes in these things. But unfortunately, choosing one or the other seems to involve a worldview and a self-view. So people who are very in love with efficient markets tend to pride themselves on their rationality also. And,
Now, have you ever been involved in an open debate with, a Gene Fama?
oh yeah, well you mentioned Gene Fama.
Yeah.
I had a whole week debating. There's something called Nobel Week after our Nobel Prize.
Yes.
The thing that struck me is, first of all, I like the guy. I'm very impressed with him.
Sure.
But we don't really disagree much on the facts.
Huh.
It's all down into interpretation.
Yeah.
So what it seems like he wants to, when he's famous for identifying anomalies,
Right.
but he likes to come up with the idea that how do you know it's not rational? For example, crazy dictators in history, are they rational? They look crazy to me. But it's an act. They really are doing this. It's a political game they're playing. They're really smart people.
Crazy versus crazy like a fox, huh?
That's right.
Okay. So then in terms of the second bubble that was developing, so now we're talking about the period between 2002 and 2008 where real estate starts going up, and starting around 2006, according to the Shiller index, the peak of the real estate market in the United States hits. What were you saying and what were you thinking during that period of time? Because I know you were making statements publicly about the high value real estate.
Well, one thing I did is create a home price index back to 1890. Nobody had one.
Right.
You just look at the picture, and I show the picture, you say, wow, look what's happening right now.
Yeah.
It looked anomalous. Then the question is, what to make of it? Something is unusual. And is it interest rates, or is it some policy of taxes or population growth? So I worked with Carl Case on this. We couldn't seem to find anything like that. There was nothing plausible except bubble. Now that was still a contentious word. And even in 2013, during Nobel Week, when I said the word bubble, I could see Eugene Fama squirming. He didn't like that. He called it that nefarious term, and he said it's never even been properly defined what it even is.
Yeah.
So, but of course, it's often used careless. There are certain terms that are used more by the press, the newspapers, than academics, and often carelessly used. But I think there's an element of truth. There are bubbles. There are times of popular excitement.
Right.
People see prices going up in some market, they get excited. Smart money stays out, and sometimes they short. But as we know, the short sales are sometimes not enough, especially in housing. You can't short
a house.
Yeah.
Right. Also, according to your home price index, I looked at the series going back to 1890, so it's a fantastic research tool, and it's a real home price index. You adjust for inflation, so you compare apples to apples across time. And the amazing thing is, between 1996 and 2006, home prices nearly double in this country.
Yeah, right.
And much higher than over the course of the last 5 decades. And so when that was going on, what were you doing in terms of speaking to the press? Because I know you made a number of public statements about this. What were you doing, and how was it received?
Well, I was still a little bit diffident. I was writing newspaper columns, but I didn't really know either. History is inscrutable.
Well, nobody has perfect market timing, so you can't time these things. But
And I have an academic attitude that I don't want to make statements that I can't support. On the other hand, when I'm writing a newspaper column, it's a little bit different.
Sure.
People want to know what you're thinking, and as long as you don't oversell, you can tell people what you're thinking. So again, once again, it was similar. It seemed obvious. I was visiting Phoenix, which had rapidly, it was a little bit late to the bubble, but then prices were really soaring. And I mentioned to my cab driver from the airport, what's going on in home prices? Boy, did that set him off. He wanted to talk and talk and talk, point out different houses and what they sold for.
so this is your restaurant test all over again.
Yeah, it's the same.
When people
yes.
start talking about real estate, yeah. So now the real estate bubble has burst in 2008-9. We have the financial crisis. Any observations post-mortem in terms of what happened and what we might do to prevent these kinds of things from happening again, or are they just inevitable?
Well, some of it is inevitable because people are people, and also they may not be the end of the world. We don't want the remedy to be worse than the issue. So, people are excited by bubbles, and to some extent, this excitement about investing does lead to good outcomes. Maybe it doesn't have to come all at once. It doesn't have to be gradual. So it's a human phenomenon that. The countries that have the biggest bubbles and bursts are some of the most successful countries. On the other hand, we don't really want people to get caught in them and have their lives disrupted. So what I often say is get a financial advisor and get one that good people recommend.
Right.
They generally are helpful.
Yeah. Well, so now that brings me to the main subject of our interview, which is the perfect portfolio. Can you tell us a little bit about your perspective on the portfolio management industry to begin with? And then I'm going to turn and ask you to tell us a little bit about what you think the perfect portfolio is for the typical investor.
Well, okay, when you say perfect portfolio, it brings me back to some mathematics, the capital asset pricing model. And you can define, now some people would say that perfect portfolio is the same as the market portfolio, because if everybody is doing that, then it is the same.
Right.
But I think that's where the capital asset pricing model is being overextended.
Okay.
Not everyone is doing that.
Right.
So you have to make some sense. Not many people are very quantitative about, you have to invert a matrix, that sort of thing.
Yes.
And we don't know, the future is still a little fuzzy.
Yeah.
So I guess it has to be a widely diversified portfolio. I think people are too afraid of investing abroad, generally, or across major asset classes. And also, I would say it has to deal with your own vulnerabilities. If you work in the automotive industry, you shouldn't put a lot into automotive stocks. You might want to short them. Hardly anyone does that. So I think also that the perfect portfolio would involve some financial innovations. For example, I have been advocating for years now that governments issue GDP-linked bonds.
How does that work?
Well, the simplest GDP-linked bond, my work with Mark Kamstra at York University, is what we call a trill. It's just a share in GDP. A trill is 1/1,000,000th of the country's GDP.
Okay.
So if the GDP of the U.S. is 18 trillion, then this year you get $18 dividend on one share.
I see.
And that just goes forever, paid in local currency. But see, if you have it would benefit both investors and governments. Governments would be putting themselves into a less leveraged position. Instead of borrowing at a fixed rate, they would be borrowing. It's like equity, it would be borrowing in such a way that their tax revenues would correspond to their obligations. And for investors, it would be a much more wide diversifying move. The GDP is much bigger than corporate profits. It's typically 10 times bigger for each country. And so investing in GDP is a much broader diversification than investing in stocks.
Yeah, this is very much along the lines of your general theme on macro markets, trying to create
Right.
markets that don't yet exist. And from an economic perspective, that makes total sense because you're completing the market and allowing people to hedge. Has that gotten any traction from the folks that could actually implement these ideas?
Well, the interesting news may be coming soon, I hope. The G20 nations, in the Turkish year, they were talking about Erdem Başçı of the Central Bank of Turkey was interested in GDP-linked bond, but I don't think it made it into the G20 statement. Next year, it's Germany, and I was at a G20 conference, and I was talking it up. So were other people. Mark Carney at the Bank of England is interested in them.
Yeah, it's a great idea to be able to hedge these kinds
Yeah.
of risks because otherwise there's no other way for individuals to deal with things like business cycle downturns and recessions and so on.
And these things happen. They happen slowly. Financial innovation is slower than... The fastest innovation is in these mobile phones or apps.
Technology.
Man, we get them right away. And it's fun. But the problem with investing innovation is that you don't see the outcome right away. And people are mistrustful of financial innovations.
Well, so I want to close, Bob, with one final topic to talk about your work on markets and the good society. Tell us a little bit about your perspective and what you're working on now.
The word good society is an old phrase referring to, I like to define it as just nice people, okay? Financiers often don't seem, sometimes they don't seem like nice people, but they really are and really can be.
Yeah.
So the good society is a society that encourages human development and freedom and good health and all these nice things. How do we get that? I still, despite all my interest in human behavior, think that a free market, democratic system, it's not a totally unregulated free market, but with a civil society that oversees regulations is a good thing. So I've written, also with Akraloff, I've written about a vision for society, but it's not really our vision, it's just emphasizing what's happened in the past. And financial innovation is part of it. It's absolutely a part of it. What people face risks in their lives, and how do we in fact really deal with that? It has to be a contractual, some form. It's either insurance or hedging, and it makes our life, our civilization, and also entrepreneurship is something that won't happen unless we have financial arrangements to support it.
Yeah, well, thanks to the research that you've done with your co-authors, we are a little bit closer to that good society than before. So thank you very much for joining us today, Bob. It's a pleasure.
My pleasure, too.